We've been talking about lately this market being in this consolidation range, and this has been a consolidation range that has continued now going on 3 months. The issue though is that recently we rallied off support here at the 200-day moving average, which was very good, and we broke above resistance here at the 100-day moving average, but have remained really trapped within this very tight consolidation pattern here over the last couple of weeks. And we have been talking about the issues that the markets needed to break out to the upside here in order to add some exposure to portfolios and to really return the markets back to a more bullish trend. Unfortunately, over the weekend, Italy ran into some problems financially. And look, Italy's got big debt problems. They are on the magnitude of Greece times about 12. Italy is a very, very large economy within the overall Eurozone, and what happens to Italy is going to have very serious implications to the Eurozone in total. Now, we've already talked about the British exit, right, called Brexit. There's a real possibility, and I wrote about this 2 years ago, is that because of the debt situation that Italy currently incurs within the global EU, an extraction of Italy from the EU is a very likely probability. Well, that has now come to roost here a couple of years later because of that very same issue. With the European Central Bank now trying to extract liquidity from the markets, Italy is becoming a much bigger issue. Now, that's one thing. The other big issue is remember back in 2008, the markets were correcting in early 2008. June, July, August, the markets are down about 8%. No big deal. We're going through a correction in the markets. And then September the 18th, Lehman Brothers files for bankruptcy. When Lehman Brothers filed for bankruptcy, it froze the credit system across the planet because of what they call counterparty trading. This is all the investment banks, Goldman, Lehman, JP Morgan, Bank of America, Deutsche Bank, all these big major banks, they cross deal with each other on bond issuances, swaps, etc. It's a very integrated market. Lehman filed for bankruptcy, it froze the entire financial system. Deutsche Bank is about 5 times the size of Lehman. So if you can put this into context and scale, Europe is a much bigger problem to the global economy than the US was back in 2008. So don't dismiss the potential here that if something goes wrong with Deutsche Bank or with Italy, there's a real risk here to the financial markets. Now, I'm not saying that's going to happen, but this is what the market was sniffing out today, and we did break that important support at the 100-day moving average. The most likely trip right now is probably going to be a decline back to the 200-day moving average over the next couple of weeks. We'll see if this occurs. If the market by the end of this week cannot get back up into this trading zone, we are most likely going to retest the 200-day moving average. So we're going to keep holding our powder dry for right now until this market kind of figures it out. Remember, we only trade based on weekly data. So what happens today on Tuesday is really not important. This is something, though, that sends a message, and we definitely want to pay attention to this. But we're not going to make any decisions financially until the end of this week where we see the markets actually settle out for the week. This could be a one-day knee-jerk reaction, and doing a bunch of selling and panicking here just because of a one-day move could prove not to be beneficial to portfolios. We are watching our positions, of course. We understand where we are. But again, we want to wait to see where we are at the end of the week. Now, let me show you one other thing, though, here that I've been warning about here for a while that is very important to the context of this overall market. I've been telling you for a while now that interest rates have not been really telling the same story as what the stock market was saying. What happened with interest rates is interest rates have now been bottoming for the last several months. And every time we get down to these levels, and particularly right around 3%, the markets have found support. And I talked about over the last couple of weeks that the bond market was beginning to make a turn, and it looked like money was flowing out of risk back into safety under concerns about what was happening in the market, particularly as interest rates pierce 3%, the impact on overall economic growth, and ultimately with what happens with earnings. Don't forget that interest rates are not an isolated event. Interest rates, way more than stocks, impact the everyday life of consumers. Variable rate credit cards, subprime auto loans, mortgages, etc., short-term loans, payday loans, all these type of things that individuals use on a daily basis are immediately and directly impacted by interest rates. The problem here is unlike stocks, which has a very low participation rate in the overall economy, interest rates affects everybody in the economy. And as I've been talking about the last couple of weeks, we talked about the large short position in treasuries, and we said if there's a catalyst, you're going to have a big explosion in bonds. We've been adding some bonds to portfolios as of late because of that, and this is what's happened just in 3 days. We've had a very sharp rally in bond prices, and we are now moving right close to penetrating and moving back above the 200-day moving average. This is a potential trend change to the entire interest rate dynamic, and if this continues, a move above the 200-day moving average on the 10-year Treasury will suggest that rates are going to go back down closer to 2% before we see 3% again. This has implications on a variety of fronts in terms of the economy as well, because if we start pushing down towards 2% on the 10-year Treasury, we're going to be talking about a nearly inverted yield curve. An inverted yield curve historically has been a good indicator of upcoming recessions within the economy. Now, this could very well be a knee-jerk reaction that fades in a couple of days. Again, this is just a one-day move here at this point. But again, pay attention to what's happening here on a global scale. This isn't simply the one-off event that a lot of people are making it out to be. This has much further reaching implications, particularly through the financial markets and the economy. So again, continue to pay attention to this. Nothing to worry about at this moment. Don't make any knee-jerk reactions. We're watching this very carefully. We'll continue to report on this both on our website at Real Investment Advice as well as our weekly newsletter. So if you get subscribed at the website, simply enter your email address. We'll keep you up to date on all of our analysis, and of course, we'll keep you up to date every night right here on the radio show as well, realinvestmentadvice.com.